everybody. So today we're going to talk about a bank smackdown. So many of you may or may not know that there are 27 banks in trouble that have either been downgraded, negatively rated, or are under review. More on that in a minute. So there are many rating services, one of which is Moody's, another one is Fitch. Essentially, these agencies rate banks just like they rate you. They basically have a credit score just like yours. So when you go in to get a home loan and you have a credit score that's bad, it's harder to get a loan. And of course, they look at you as more of a risk. So Moody's and Fitch, some of the other rating services, have a system of ratings, which we're going to go into in a minute. So these are three articles that are recent. Moody's downgrades U.S. banks and awards, possibly cuts of others. Of course, those are the ones that are under review. Moody's downgrades banks, affirms U.S. recession forecast. Some people are saying that these bank credit problems could turn into recessions. Of course, the last article, Moody's downgrades regional banks, and that's why they're sticking with the preferreds. Essentially, what they're saying is move from the small and regional banks into the larger big banks, which we're going to talk about in a minute. So many of the news articles are just going to focus on the 10 banks that are downgraded, but I also want to talk to you about the other 17 banks that have moved from stable to negative, or at least are under review. As you can see here are a list of all the banks. One thing to be clear here is that banks are businesses. They have assets and they have liabilities. And when some of those assets turn toxic and when they have liquidity issue or valuation problems, that's when they move from being downgraded, stable to negative, or even under review. So what does all this information tell us and what should we be concerned about? Well, all we got to do is simply take a look at the banks that have already collapsed recently and see what's happened before, during, and after on those specific banks. So of course, we know we had the collapse of Silicon Valley Bank, and of Signature Bank, and of course, First Republic. So it's important to understand that some of these banks are huge banks. Not all of these are small regional banks, like the Bank of New York Mellon, as you can see, U.S. Bancorp, and Truist. These are huge banks that are now under review that they could move from being negative to, of course, being downgraded. So what is a bank rating? As I mentioned before, the banks get rated by many different agencies, and right now we're focusing on the Moody's ratings, as you can see here. And essentially, what it is, it's a measure of their financial soundness. That's all it is, just like they do to individuals, just like your individual personal credit score. And of course, one agency involved here is the FDIC, the Federal Deposit Insurance Corporation, because, of course, they're the ones that are insuring many people's deposits. Just like we saw, they became involved when Silicon Valley Bank went down. Next slide is how Moody's takes a look at the financial factors of a bank. So just like an individual, you can see how it's weighted with the four boxes at the top. You've got asset risk, capital, of course, is it profitable or not? The funding structure, and of course, liquidity. Those are the four boxes that make up 100% of the financial factors of how Moody's rates a bank. So there's a lot more detail behind all of these boxes, so we don't have time to go into that today. But as you can see, as assets become less valuable, there's solvency issues. And of course, as the capital starts to be at risk, there's liquidity issues, both, of course, reduce their financial profile, which is at the very bottom of the slide. It's important to know that since 1933, not one person has lost deposit money due to a bank failure, says the FDIC on their own website. This was certainly the case recently at Silicon Valley Bank. So let's take a look at what I think are the potential problems and something that maybe you should be looking at as well. Number one, we've addressed deposits. So number two is what we call the counterparty risk. And counterparty risk is essentially just debt investors. And oftentimes, you guys don't completely understand what a debt investor is. There are people that invest in debt, and that debt is against some kind of a collateral. And when that collateral goes down in value, then those debt investors have a problem. That's called counterparty risk. Another way to think of counterparty risk is somebody's individual credit score. If you're going to lend money to somebody and they have a poor credit score, therefore a lower credit score might be riskier to you. So you might ask from that borrower more deposits, more reserves, for example, to be able to cover the payment in the future based on their actual credit score. This counterparty risk is now a big deal because these bank ratings have gone down, just like if a bank was looking to you to provide more capital just to keep the asset. Now, as you can see from the circle on this graph, we've got the higher interest rates, the loan maturities, liquidity, which we talked about in the prior slide, and of course, inflation, which are the next four red stars in this slide. As you can see, each one of those stars represents some kind of debt. And that debt, of course, rolls back up to the counterparty risk, which is sitting at number 2. So higher interest rates mean higher costs. Loan maturities means that some of those values have gone down. The liquidity is being sucked out from the higher interest rate costs. And of course, inflation is affecting everybody. So behind counterparty risk are these 4 red stars, all representing debt that have a higher rates, potential loan maturity issues. Their liquidity might be gone as a result of them using reserves just to pay for the higher interest costs. And of course, inflation, which is affecting everyone at the same time. This all leads to defaults. And we're definitely starting to see that on a lot of commercial real estate and, of course, in some single family. So let's take a look at what are some of the bank options. So there's only 2. One is a bail-in and a bailout, and they're designed to prevent the complete collapse of a failing bank. We've seen this before, and the difference between the 2 lies primarily and who actually bears the financial burden of rescuing the actual bank. With a bailout, the governments actually inject money back into the troubled banks and corporations to help them avoid bankruptcy. We definitely saw that back in 2008, 2009. In the bail-in, the banks use the money from depositors and unsecured creditors to help them avoid failure. This is more like what happened with Silicon Valley Bank, where the investors of the bank actually lost all their money, but the depositors were made whole. So nobody's talking about what happened with Silicon Valley Bank after it went down, but this is actually what happened. Silicon Valley Bank's new owners are First Citizens Bank, which is a billionaire family out of North Carolina, and they're quietly building a banking empire. But let's take a look at all the moves that happened. Number 1, officials from the Treasury, the White House, and the Fed all tentatively agreed 2 bold moves as they finalized and announced late Sunday night, as you guys remember this, that the government would ensure that all depositors would be repaid in full. I think this is important, and this is what everybody's freaking out about. I don't believe that depositors are going to have a problem. And the Fed would offer a program that provides attractive loans to other financial institutions in hopes of avoiding a cascading series of bank failures. In a sense, this was a government bailout because the government got involved and provided loans to First Citizens to be able to purchase Silicon Valley Bank. So how did the actual deal go down? So First Citizens Bank took on $110 billion in assets, and $56 billion of that is in deposits, and $72 billion are loans from Silicon Valley Bank. They are now one of the top 20 banks in America. On the $72 billion loan portfolio, they actually acquired it at a $16.5 billion discount. This is what the FDIC said in the press release. Then you can actually see from the SEC filing that they actually received from the FDIC a $35 billion 5-year loan at 3.5% fixed rate to finance the actual deal. So most of you might not be in the mergers and acquisitions of banks, but if you start to think like a bank, it's no different than the way you're trying to acquire real estate. These banks are actually after the assets and the deposits and the customers of those individual banks that are in trouble, just like you would be on a value-add piece of real estate. So as I always say, be the Fed, because these banks are actually buying assets, and as you can see, these loans that were toxic were discounted, and then they got financing through the FDIC, just like you would do on your own individual real estate portfolios.